Dan Proft and Donna Brazil go head-to-head at Beyond the Talking Points on Thursday, March 22nd. Tickets are on sale now at 560theanswer.com/beyond.
Good morning, Dan and Amy. There's an interesting piece in U.S. News recently from Desmond Lockman, who is an economist. He worked both at the IMF as well as the Federal Reserve. I think the IMF actually in Wall Street. I'm not sure he was ever with the Federal Reserve. But he makes the point that a crisis is coming, that all the ingredients are in place for a catastrophic economic and financial market crisis, perhaps as bad, if not worse, than the 2008-2009 financial market crisis. He points to two indicators. One is that we have asset bubbles. Asset bubbles and credit risk mispricing that are worse than they were on the eve of the Lehman Brothers bankruptcy in September of 2008. Talks about troublesome housing bubbles in economies like Canada, China, and the United States, as well as mispricing of credit risk in the world's high-yield and emerging market corporate bond markets. And then he also talks about the easy monetary policy over the last several years, the quantitative easing, that contributes to this. Now, I could have a debate with myself on this about Mr. Lockman's piece, but thankfully we've got Steve Moore to discuss this, Wall Street Journal columnist, Heritage Foundation economist, CNN senior economist. He's got all the credentials to respond to the concerns raised by Mr. Lockman, and so let's let him do that. Steve, thanks for joining us. Appreciate it.
Hi, Dan. Hi, Amy. Thanks for making my Wednesday morning with that cheery report.
Well,
I don't even know who this is. Who's this you're talking about?
He's a former macroeconomist for the IMF, and he's also had a Wall Street career, so he's been in private.
The IMF, the people at the IMF are the ones who said that if Donald Trump was elected president, that the economy would crash and the stock market would
come on.
Go through
I understand, but let's not do the logical fallacy of attacking the source. Let's go to the argument.
Anybody from the IMF is very, these people are most always wrong. So, but look, I'm optimistic. I mean, I have exactly the opposite viewpoint. I think we're on the verge of, as my buddy Larry Kudlow says, the biggest investment boom we've seen in this country in 30 years. Everybody wants to come to the United States right now and invest. You're seeing the massive inflows of capital. You're seeing businesses spending a lot, in terms of building new factories, investing in new technologies and equipment. We're creating a lot of manufacturing and construction jobs. So I don't see it. Now,
you could have growth. You could have GDP growth and also have a market pullback because of mispricing, right?
That's true. Now, look, that's true. And I was one of the people, when the market went up to 26,000, I said, look, maybe the market's run a little bit ahead of itself here. Maybe there's a little bit of irrational exuberance. And now we're back at around 25,000. I'm not going to predict what's going to happen with the stock market next week or next month. But I will say this. I think all the conditions for a big, a sustained boom are in place. With the tax cut was a big deal. It was a game changer. It means that asset values are much higher now because the government doesn't take as much of the profits from the assets. So I like the outlook for the U.S. I'm predicting we're going to get 3.5% growth in 2018. That's, we haven't had 3.5% growth since, at least 20 years. So all the indicators now, look, are there some things to worry about? Yeah. I mean, I'm a little bit worried about the trade agenda. I thought what Trump did earlier this week with the aluminum and steel import quotas was crazy. Now we're seeing an increase in steel prices, and that's making American cars more expensive, American manufactured
beer and canned vegetables. Beer and canned vegetables.
See, I don't buy those, Amy, but I think you do.
Amy's mostly concerned about beer.
Are up and are upward. Yeah. And then also, too, if you want to buy a washer and dryer, that cost went up. Why?
Yeah, so here's the point. I mean, the Donald Trump, I think he has his heart in the right place here. I mean, he wants to make, steel and aluminum and products in the United States. But what he doesn't get, I've tried to talk to him about this, and, I don't think he fully gets it, is that, steel is, I mean, the worst possible things to put a import tariff on is something like steel and aluminum, because it's in everything that we produce. So it makes everything else we produce more expensive. So this could actually make, believe it or not, paradoxically, this could make our trade deficit worse, not better.
Well, there's no question that the policy that hurts American consumers is nonsensical policy, and I don't really care about the president's intentions. I care about policy outcomes, and so he's wrong on that. But another concern, though, is what about the debt load? I mean, there's a lot of concern about rising interest rates, but frankly, that incentivizes saving and rewards savers, and we should be rewarding and incentivizing saving with the debt load that people are carrying.
So actually, if you look at the debt load, I mean, this is one reason, I think this analysis that, our debt situation is where it was back in 2008 is completely wrong, actually. I mean, now look, government debt burden is up substantially since 2008, no question about it. I mean, Bush and Obama doubled the national debt in 10 years, so no doubt about it. But if you look at household debt, actually, it's come down a lot since 2008. We don't have the massive debt burdens that we did back 10 years ago. And corporate debt, business debt, is way down. So, the only area where debt is alarmingly high right now is the public sector, government debt. So yes, we have to do something about it. We have to control spending. But if you look at corporate balance sheets today versus 2008, I mean, today, corporate balance sheets are gorgeous. I mean, they're very lowly leveraged. They were leveraged up to the eyeballs back in 2006 and 7 and 8. So I just don't see that comparison. Now, I do worry a little bit about the dollar. Trump and Mnuchin, and I like Steve Mnuchin a lot. He was a hero on the tax bill, but remember Dan Amy about a week or two ago, he said, I want the dollar to be weak. We don't want a weak dollar. I mean, Larry Kudlow and Laffer and I just wrote a big piece on this in IBD. Thanks for mentioning it, Dan. But we basically said, look, successful presidents are presidents that have strong dollar policies, not weak dollar policies.
Well, right. And just on the interest rate piece, I wanted to make the point, I should have perhaps been more clear, that rising rates will hurt companies that have bad management and bad products. So, for example, if GE goes out of business, that I won't lose sleep over that. But I'm just saying that it will treat some companies, cause chaos for some companies that have bad management and bad products, but not the economy as a whole. And people need to understand that separation.
I agree with that. And since we're doing Economics 101 for your listeners this morning, which is good, I think a lot of people need these economic lessons, because what you hear from professional economists is almost always wrong. There's this fear out there that
it's like the weatherman in Chicago.
It's true. I mean, most of what I learned in my textbooks. No, truly, most of the stuff they teach in macroeconomic textbooks is completely the opposite of true. They teach Keynesian economics, which is entirely wrong. But there's a superstition out there that when the economy picks up steam, as our economy is,
we're overheating,
and the economy and more people are working and wages rise, that this causes inflation. And I think that's fundamentally false. Now, it could cause inflation if it's driven by a massive increase in the money supply. But here's the point. Art Laffer taught me this, and it's one of the great economic lessons. If the economy produces more apples, the price of apples fall. They don't rise. So if we continue to have this increase in output and continue to increase our manufacturing and so on, the price of these goods and services is going to fall. They're not going to rise. So I'm not looking at runaway inflation out there. I don't see it.
Well, that's why I wanted to point out, because this is good. The Keynesian argument that's happening right now, including by this piece that I referenced, which is why I wanted you to address it to present the contrast for people, is the idea that overheating. It's a term that that Keynesians love to throw around when things are good, like you have full unemployment. And in point of fact, the Amazonification of the economy, if you will, is actually creating deflation.
Yeah. Well, good point. And by the way, it's so funny because that term has re-entered the lexicon back in just the last week or two. I mean, hearing all these economists say the economy's overheating, it's overheating, and I haven't heard that since the mid-1980s.
Yeah, exactly.
And what a wonderful problem to have yes, there's too many people working. People are getting pay raises, they're too large. Now, the same people are saying that the economy is overheating. The same people, again, a year and a half ago said that Trump is going to destroy the economy. Now their argument against Trump is that the economy is too weak and that it's too strong. You can't win with these people.
Yeah. How many corporations do you think that were making products overseas are now bringing it back to America?
A lot are. I mean, look, the biggest announcement that happened in economics in 5 years was the Apple announcement, that we can't talk about enough because it's just so gargantuan. Amy, they're bringing $300 billion back to the United States. I was on CNN a week before the tax bill passed. I don't know if I told you guys this story already, but, I was on with Robert Reich, and I predicted on that show that if we pass the tax bill, Apple would bring $100 to $150 billion back to the United States. And my God, Robert Reich said, Steve Moore is lying. He doesn't know what he's talking about. He's a completely, just a shill for the administration, blah, blah. Well, it turns out Robert Reich was right. I didn't know what I was talking about because they didn't bring $100 to $150 billion back. They brought $300 billion back. I mean, that's a gigantic number. And you're seeing, look, think of these companies, FedEx, Walmart, Costco, Verizon, AT&T. I could go down, keep going down the list of these companies that are either bringing money back or investing right now in new equipment, new machinery, new plants. I mean, Apple is going to build a new campus with 20,000 new workers.
Well, and the interesting thing, too, is despite the rhetoric, the dismissive rhetoric of Crumbs Pelosi and her gang, we see this week that it went from all of the hysteria backed by the D.C. press corps making the tax cuts prior to their passage unpopular, to now a majority of the country supports the tax cuts because they're seeing the real world impact on them.
And I predicted that on this show. You go back and replay the tape. I said exactly that was going to happen because when we passed the tax bill, it was with 26% public support. And what we told the Republicans, just wait till people see the tax cut. And they realized that Nancy Pelosi and CNN and MSNBC were lying to them. And people are now saying their paycheck, and they're like, hey, they were lying. My paycheck is bigger. It's not smaller.
Imagine
nice,
that.
isn't it?
Imagine that. Pelosi and the Democrats lying to us. Steve Moore, Wall Street Journal columnist, Heritage Foundation, CNN, former Trump campaign advisor. Steve, thanks as always for joining us. Appreciate it.
Have a great week, guys. Take care.
You too.
All-around good guy who joined us on our turnkey.pro answer line.
This only